Hello and welcome to our latest podcast. Today we are going to be discussing one of the hottest topics in private equity, co-investing. Co-investing is an increasingly popular activity amongst investors, where investors combine their resources to invest in a single deal alongside a private equity firm. But what are the benefits and drawbacks of this type of investment? Firstly, let's look at the benefits. One of the main advantages of co-investing is improved deal access. By combining resources with a private equity firm, investors can gain greater access to investment opportunities and enter more deals than they would be able to on their own. This can in turn lead to higher returns and greater diversification of portfolios. Another benefit of co-investing is the ability to lower fees. Private equity firms typically charge management and performance fees on their investments, which can eat into returns. However, by co-investing, investors can reduce these fees, which ultimately means more cash in their pockets. Co-investing also allows investors to leverage the expertise of private equity firms. By working with experienced investment professionals, investors can gain access to their knowledge, networks, and skills, all of which can lead to better investment decisions and improved returns. However, despite these benefits, co-investing also comes with a number of drawbacks. One of the main risks associated with this type of investment is the potential for a lack of control. When investing alongside a private equity firm, investors often have little say over the management of the underlying assets, which can leave them exposed to risks that they are unable to control. There is also the risk of increased competition for deals. Co-investing has become increasingly popular in recent years, which means more investors vying for the same deals. This can not only lead to less attractive investment opportunities, but also higher purchase prices and lower returns. Finally, co-investing may not be suitable for all investors. This type of investment requires a significant level of expertise and understanding of the private equity market, which may not be accessible to all investors. This means that investors without the necessary knowledge or resources may find themselves exposed to greater risks and ultimately, lower returns. To conclude, co-investing can be a highly attractive investment strategy for many investors. By combining resources with private equity firms, investors can gain access to a wider range of deals, lower fees, and gain invaluable expertise that can lead to better investment decisions. However, this type of investment also comes with a number of drawbacks, including the potential for a lack of control, increased competition for deals, and suitability issues for certain investors. That's it for today's podcast. We hope you found this information useful and informative. Stay tuned for our next episode where we will be discussing another hot topic in the private equity market.